For decades, the entire global financial system has basically been running on one simple rule: borrow for next to nothing in Japanese yen and invest it anywhere else for a profit. Well, that era is now coming to a very dramatic end. The strengthening yen we're seeing isn't just another blip on the currency charts. It's a structural shift, a real tectonic event, and it's got profound consequences for pretty much everyone. So that really brings us to the core question here, doesn't it? Is the era of cheap Japan officially over? The answer to this is going to redefine investment strategies and the flow of global capital for years to come. All right, let's dive in. Here's how we're going to break this all down. First, we'll look at the end of cheap Japan itself, what's actually happening. Then, the political forces that are giving this whole thing a green light. After that, we'll get into the really surprising winners and losers at the corporate level. And finally, we'll try to chart a course for this new global equilibrium. Okay, first up, the end of cheap Japan. You can think of this as the epicenter of the earthquake. The Bank of Japan has finally made a move that financial markets have been both anticipating and, frankly, dreading for years. The key number to focus on is 0.75%. Now, I know that might not sound like a lot, but what it represents is huge. This rate hike officially ends an 8-year experiment with negative interest rates. It's the highest Japan's policy rate has been in nearly 30 years, signaling a historic turning point and an end to the world's last anchor of zero-cost money. To really get why this matters so much, we have to talk about something called the yen carry trade. For decades, this has been one of the biggest, if not the biggest, trades in the world. We're talking hedge funds, pension funds, you name it. They would borrow yen at almost zero cost and then pour that money into US stocks, emerging market bonds, basically anything with a higher return. The Japanese yen was, quite literally, the cheapest funding source on the entire planet. And look, the sheer scale of this risk is just staggering. We're talking about a multi-trillion-dollar strategy. So when that much borrowed money has to suddenly reverse course, a process called deleveraging where you have to sell off assets to pay back your loans, it doesn't just cause ripples. It can absolutely trigger a global liquidity tsunami, violently pulling capital out of markets all around the world. All right, let's shift gears a bit for our second section, because this isn't just an economic story. To really understand why this is all happening now, you have to look at the geopolitics. Turns out, the yen's rise has a very powerful but very quiet cosigner. See, here's the thing that most people miss. This isn't happening in a vacuum. The Bank of Japan isn't just going rogue here. The yen's move to get stronger actually has Washington's tacit approval, which is a subtle but absolutely crucial piece of this whole geopolitical puzzle. And you don't have to look far for the evidence. It's like a trail of breadcrumbs. First, the US Treasury puts Japan on its currency monitoring list. That's a clear signal. Then you have the finance ministers from both countries coming out and expressing joint concern over the yen's one-sided depreciation. Add to that some rumors of rate checks from the New York Fed, a classic prelude to intervention. It all points to one conclusion: Washington has gotten tired of an overly strong dollar hurting its own economy and is quietly giving Japan the green light to strengthen the yen. And this right here, this just lays it all out perfectly. For years, these two central banks were moving in opposite directions. The US Fed was tightening, raising rates, while the Bank of Japan was easing like crazy. Now, the roles are completely reversing. The Fed is talking about cutting rates, while the Bank of Japan is finally tightening. This narrowing interest rate gap, that is what's truly killing the yen carry trade, right at its source. Okay, this brings us to what I think is the most fascinating part of this whole story: the impact on the ground. You know what they say, when the tide goes out, you find out who's been swimming naked? So let's look at the corporate winners and losers in this new world. Now, the conventional wisdom you always hear is that a strong yen is just terrible news for an export-heavy economy like Japan. But is it really that simple? Is it bad for all Japanese companies across the board? Well, that's a common misconception, and the reality is way more interesting. To really understand what's going on, we have to stop looking at the big picture for a second and dive into the microstructure of corporate Japan. For the automotive giants, companies like Toyota and Nissan, the situation is incredibly tough. They are getting hit with what you can only call a double squeeze. From one side, you have the looming threat of a 15% US tariff. And from the other, every time the yen gets stronger, the profits they earn overseas are worth less when they bring them back home. It's a classic pincer movement on their bottom line. But here's where this story takes a sharp turn, because not all exporters are built the same, not even close. The contrast is just stark. Automakers are in a brutal, price-sensitive fight. They have very little pricing power. But then you look at a company like Tokyo Electron, which makes semiconductor equipment. They don't compete on price. They compete on technology. They have a virtual monopoly on some of this stuff, giving them incredible pricing power. They can even demand to be paid in yen, which shifts the entire currency risk over to their customers. So what does this all mean? It's a fundamental shift. In this new strong yen era, the entire basis of competition changes. It's not about being the cheapest anymore. It's about having a technological moat so deep that your customers have no other choice. Value completely replaces price as the name of the game. And hey, this logic doesn't just apply to manufacturing. You see the exact same thing in services like tourism. The days of tourists flocking to Japan just for cheap shopping sprees, that's ending. The future is all about providing unique, high-value experiences that people are willing to pay for, no matter what the exchange rate is. It's a painful upgrade, for sure, but a necessary one. All right, so let's pull all these threads together in our final section. Let's synthesize what we've learned and try to chart a course for this new global equilibrium that's starting to take shape. So where is this all heading? Most analysts are looking out to 2026 and seeing a new fair value range for the currency, somewhere between 146 and 150 yen to the US dollar. Now, this isn't just a number. It represents a new balance point for the global economy after decades of distortion. And what this new equilibrium really signals is a deep, strategic shift for Japan itself. The country's moving away from a model built on just exporting cheap goods, being a trading nation, and evolving into a model built on the returns from its massive overseas investments and its high-value, tech-driven exports. It's truly becoming an investment nation. But of course, a shift this big is never a smooth ride. There are some major risks on the horizon that investors absolutely need to watch. U.S. trade policy is a big one. So are potential spikes in energy prices. You've also got Japan's own domestic politics. But most importantly, you have to watch for the shockwaves from that global deleveraging we talked about, which could hit emerging markets especially hard. I've used this word deleveraging a couple of times, so let's just be crystal clear on what it means, because it is the key risk here. It's the forced selling of assets to pay back debt. As the yen carry trade unwinds, all those investors who were borrowed to the hilt are forced to sell their stocks, their bonds, anything to get the yen they need to close their loans. This sucks liquidity out of the system for everyone, and it can be a massive shock. So let's boil it all down to the single most important takeaway. The bottom line is this. In the new era we are all entering, any business model that depends on cheap capital is a losing strategy. The only real defense, the only path to survival, is building deep technological moats and a truly global operational footprint. And that leaves us with one last massive question. The end of the cheap yen is really just the beginning. It's the start of a great repricing of capital all around the world. So as Japan reclaims its monetary sovereignty, we all have to ask ourselves, who is going to feel the shockwaves of this repriced world next?